Question 1. Which of the following types of reinsurance agreements typically involves the ceding company retaining a portion of the risk while the reinsurer accepts a proportional share? A. Excess of loss reinsurance. B. Quota share reinsurance. C. Stop loss reinsurance. D. Catastrophe reinsurance. Answer: B. Quota share reinsurance. Explanation: Quota share reinsurance is a type of proportional reinsurance where both the ceding insurer and the reinsurer share the premiums and losses in a specified ratio. The ceding company retains a fixed percentage of the risk while the reinsurer assumes a proportional share, typically in relation to the original policy's limits. This structure helps the ceding company manage its exposure to underwriting while providing the reinsurer with a steady stream of premium income based on the proportional share. Excessive loss reinsurance is non-proportional and involves the reinsurer covering losses above a certain threshold rather than a proportional share. Stop loss reinsurance is also non-proportional, covering losses beyond a specific limit but without the same proportional structure. Catastrophe reinsurance is typically used to cover extreme losses, natural or other catastrophic events, often involving excessive loss structures. Question 2. Mr. Andrews, the CFO, a primary insurer, is concerned about the possibility of his company facing significant losses due to an unexpected natural disaster. He is considering reinsurance options to mitigate the risk, given that he is looking for a mechanism to cover catastrophic losses above a certain threshold. Which type of reinsurance would you recommend? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Stop loss reinsurance. D. Surplus share reinsurance. Answer: B. Excessive loss reinsurance. Explanation: Excessive loss reinsurance is the appropriate choice for covering catastrophic events or high-severity losses that exceed a specified threshold. In this case, Mr. Andrews is concerned about a significant event, such as a natural disaster, and excessive loss reinsurance would be structured to cover losses above a defined limit, helping protect the company from extreme financial strain. Quota reinsurance would be a proportional reinsurance structure where losses are shared between the ceding company and the reinsurer, and it may not be effective for catastrophic events that exceed typical policy limits. Stop loss reinsurance is designed to limit overall losses once a predefined loss threshold is reached, but does not specifically address catastrophic events in the same way as excessive loss. Surplus share reinsurance is another form of proportional reinsurance, but is typically used for smaller losses and does not specifically target catastrophic risks. Question 3. In a treaty reinsurance arrangement, which of the following provisions is most likely to require both the ceding insurer and the reinsurer to cooperate and share information regarding claims? A. Exhaustion clause. B. Claims cooperation clause. C. Retrocession clause. D. Termination clause. Answer: B. Claims cooperation clause. Explanation: The claims cooperation clause is a standard provision in reinsurance treaties that requires both the ceding insurer and the reinsurer to cooperate in handling claims, including providing relevant information and assisting each other in the claims process. This clause ensures that both parties are aligned in terms of the claims management and settlement process, which is vital to prevent disputes and fair distribution of responsibilities. Exhaustion clause typically outlines the conditions under which the reinsurer's liability is triggered, particularly in excessive loss arrangements. Retrocession clause refers to the transfer of risks from one reinsurer to another, not involving claims cooperation directly. Termination clause specifies the conditions under which the reinsurance agreement can be terminated and does not pertain to claims handling cooperation. Question 4. Which of the following factors is typically considered when determining the pricing of reinsurance premiums? A. Historical loss experience of the ceding company. B. The credit rating of the primary insurer. C. The reinsurer's corporate structure. D. The number of policies issued by the primary insurer. Answer: A. Historical loss experience of the ceding company. Explanation: When determining reinsurance premiums, one of the key factors is the historical loss experience of the ceding company. Reinsurers evaluate the frequency and severity of past claims to assess the risk involved and adjust premiums accordingly. If the ceding company has a high loss history, the reinsurer may increase premiums to account for the higher risk. The credit rating of the insurer may influence the financial stability and solvency of the primary insurer, but is not the primary factor in pricing reinsurance premiums. The reinsurer's corporate structure is generally more relevant to operational considerations and financial stability, not directly to pricing. The number of policies issued by the primary insurer does not directly impact reinsurance premiums unless it correlates with the overall risk exposure. Question 5. Mr. Thompson is considering entering into a reinsurance treaty with a reinsurer. He wants to ensure that in the event of a dispute regarding a claim, there will be a clear and effective way to resolve it without resorting to litigation. Which of the following clauses would best address this need? A. Claims cooperation clause. B. Arbitration clause. C. Excessive loss clause. D. Retrocession clause. Answer B. Arbitration clause. Explanation. The arbitration clause is designed to provide a clear and structured process for resolving disputes between the ceding insurer and the reinsurer. It sets forth how disputes will be handled through arbitration rather than litigation, which is often faster, less expensive, and more private. This clause helps avoid prolonged legal battles, providing a more efficient dispute resolution mechanism. Claims cooperation refers to the mutual sharing of information between the ceding insurer and reinsurer but does not specifically address dispute resolution. Excessive loss clause outlines the conditions under which the reinsurer covers losses exceeding a certain threshold but does not pertain to dispute resolution. Retrocession clause addresses the transfer of risks from one reinsurer to another and is unrelated to the resolution of claims disputes. Question 6. Which type of reinsurance arrangement is best suited for covering a primary insurer's losses from events that are high in frequency but low in severity? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Stop loss reinsurance. D. Surplus share reinsurance. Answer B. Quota share reinsurance. Explanation. Quota share reinsurance is well suited for covering losses that are high in frequency but low in severity. In this arrangement, both the ceding insurer and the reinsurer share a portion of the premiums and losses, making it effective for managing a steady stream of smaller claims. The reinsurer's proportional share helps the ceding company manage the cumulative impact of frequent, lower-cost losses. Loss reinsurance is better suited for catastrophic or high-severity events, not frequent low-cost losses. Stop loss reinsurance applies when ceding insurers' total losses exceed certain amount, which may not be ideal for frequent, low-severity claims. Surplus share reinsurance is used when the ceding company wants the reinsurer to assume proportion of risks above certain retention level, typically for more severe losses. Question 7. Which of the following reinsurance contract provisions outlines the terms under which the reinsurance agreement can be terminated or cancelled? A. Claims cooperation clause. B. Exhaustion clause. C. Termination clause. D. Retrocession clause. Answer C. Termination clause. Explanation. The termination clause outlines the conditions under which a reinsurance agreement can be terminated by either party. This may include circumstances such as failure to pay premiums, insolvency, or other specific breaches of contract. It provides a clear understanding of how and when the contract can end, ensuring that both the ceding insurer and the reinsurer are aware of their rights in such situations. Claims cooperation clause addresses how both parties should collaborate on claims, but does not pertain to contract termination. Exhaustion clause is related to excessive loss reinsurance, indicating when the reinsurer's obligations begin after losses exceed certain threshold. Retrocession clause pertains to the transfer of risks from one reinsurer to another and does not address contract termination. Question 8. Which of the following types of reinsurance agreements would be most appropriate for a primary insurer seeking to manage risk from large, unpredictable losses such as those caused by natural disasters? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer C. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is best suited for covering large, unpredictable losses such as those caused by natural disasters. This reinsurance type kicks in when losses exceed a specified threshold, protecting the ceding company from catastrophic events. It is often used for high-severity, low-frequency events like earthquakes or hurricanes. Quota share reinsurance would involve proportional share or losses, which may not be ideal for catastrophic, high-severity events. Surplus share reinsurance is typically more appropriate for medium to high-frequency losses, but it does not address large, unexpected losses as effectively as excessive loss. Stop loss reinsurance generally addresses aggregate losses over a specific period, but it is less specialized in managing the extreme nature of catastrophic events. Question 9. Which of the following reinsurance structures would most likely be used to cover an insurer's exposure to frequent but low severity losses? A. Excessive loss reinsurance. B. Stop loss reinsurance. C. Quota share reinsurance. D. Surplus share reinsurance. Answer C. Quota share reinsurance. Explanation. Quota share reinsurance is a proportional reinsurance agreement that would be effective in covering frequent but low severity losses. In this arrangement, both the ceding company and the reinsurer share losses in a set proportion, which allows for risk diversification and smooths out the impact of smaller, frequent losses. It helps the ceding company manage its overall risk exposure. Excessive reinsurance typically covers high severity, low frequency events and is not ideal for frequent, small losses. Stop loss reinsurance covers the ceding insurer's total losses over period but does not specifically target frequent low severity losses. Surplus share reinsurance shares losses above certain retention level and is used more for higher value risks. Question 10. Mr. Martinez, an actuary for a reinsurance company, is tasked with evaluating the financial stability of a ceding company before entering into a treaty. Which of the following would be a critical indicator to assess the ceding company's ability to meet its obligations? A. Claims handling efficiency. B. Historical profitability. C. The size of the company's policyholder base. D. The number of brokers involved in the transaction. Answer B. Historical profitability. Explanation. Historical profitability is a critical indicator of the ceding company's ability to meet its obligations. Consistent track record of profitability demonstrates that the company has been successful in managing its underwriting risks and generating sufficient income to cover claims and operational costs. Financial stability is essential for successful reinsurance agreement, and profitability is one key metrics used to assess this. Claims handling efficiency is important but not direct financial indicator. The size of the company's policyholder base may influence business volume but does not directly indicate financial stability. The number of brokers involved in the transaction is factor in intermediating the reinsurance deal, but it does not directly assess the financial health of the ceding company. Question 11. Which of the following best describes the purpose of a facultative reinsurance agreement? A. It covers a specific risk or loss that is not part of the regular treaty. B. It automatically covers all types of risks a ceding company faces. C. It involves sharing risks of multiple companies under one treaty. D. It allows the ceding company to transfer risks to a foreign reinsurer only. Answer A. It covers a specific risk or loss that is not part of the regular treaty. Explanation. A facultative reinsurance agreement is a type of reinsurance where the ceding company and the reinsurer negotiate the coverage of specific risks on a case-by-case basis. It is used when a particular risk doesn't fall under the scope of the regular treaty. This agreement is not automatic and requires the reinsurer's approval for each individual risk. Question 12. Which of the following is a key benefit of using a reinsurance treaty? A. Increased profits for the reinsurer. B. Reduced capital requirements for the ceding company. C. A guaranteed reduction in premiums for the policyholders. D. Complete risk retention by the ceding company. Answer B. Reduced capital requirements for the ceding company. Explanation. Reinsurance treaties allow the ceding company to share its risks with the reinsurer, which helps reduce its exposure and therefore lowers the amount of capital it needs to hold in reserve to cover potential losses. This provides financial stability and allows the ceding company to underwrite more policies. Question 13. In a reinsurance contract, what is the main purpose of the retention limit? A. It sets the maximum amount of risk the reinsurer is willing to cover. B. It defines the portion of risk the ceding company retains. C. It dictates the amount of reinsurance premiums to be paid. D. It indicates the types of risks covered under the agreement. Answer B. It defines the portion of risk the ceding company retains. Explanation. A retention limit refers to the amount of risk that the ceding company retains for its own account before reinsurance coverage kicks in. It is typically a defined dollar amount or a percentage of the total risk. This limit ensures the ceding company is financially invested in managing its risk while transferring the remainder to the reinsurer. Question 14. Which of the following types of reinsurance is most likely to be used when a reinsurer agrees to cover losses only after the ceding company has exceeded a certain amount of loss? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Retrocession. Answer B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is used when the reinsurer agrees to cover losses that exceed a certain threshold known as the attachment point. This type of reinsurance is commonly used for catastrophic events where losses are high but infrequent, such as natural disasters. Question 15. Which of the following is a typical characteristic of a treaty reinsurance arrangement? A. It involves a case-by-case negotiation of coverage. B. The reinsurer assumes responsibility for a specific agreed portion of the ceding company's portfolio. C. It only applies to large, specific risks. D. It involves the ceding company keeping all premiums and paying for losses directly. Answer B. The reinsurer assumes responsibility for a specific agreed portion of the ceding company's portfolio. Explanation: a treaty reinsurance arrangement is an agreement between the ceding company and the reinsurer in which the reinsurer assumes responsibility for a specified portion of the ceding company's risks or portfolio. This arrangement is automatic and covers a broad range of risks, unlike facultative reinsurance, which is negotiated on a case-by-case basis. Question 16. Which of the following clauses in a reinsurance agreement addresses the distribution of premiums between the ceding company and the reinsurer? A. Claims cooperation clause. B. Premium allocation clause. C. Excess loss clause. D. Loss settlement clause. Answer B. Premium allocation clause. Explanation: the premium allocation clause specifies how premiums are distributed between the ceding company and the reinsurer. It helps define the terms under which the reinsurer receives its share of the premiums based on the risks assumed under the reinsurance agreement. Question 17. Which of the following best describes the concept of retrocession? The process of transferring reinsurance risks from one insurer to another. B. The process of reinsuring risks on a facultative basis. C. A reinsurance agreement that covers risks of the same type. D. A clause in the reinsurance agreement that limits coverage to certain risks. Answer A. The process of transferring reinsurance risks from one insurer to another. Explanation: retrocession refers to the practice of a reinsurer transferring part of the risks it has assumed to another reinsurer. This allows the original reinsurer to reduce its own exposure to large or concentrated risks, thereby managing its overall risk profile. Question 18. What is typically the main goal of stop-loss reinsurance? A. To cover catastrophic losses beyond a certain threshold. B. To protect the insurer from underwriting losses that exceed a predetermined amount. C. To cover high-frequency, low-severity claims. D. To transfer specific risks on an individual basis. Answer B. To protect the insurer from underwriting losses that exceed a predetermined amount. Explanation: stop-loss reinsurance is designed to protect the ceding company from underwriting losses that exceed a predetermined amount. This type of reinsurance covers the aggregate losses above a set level, providing financial protection if the ceding company's total losses exceed expectations for a given period. Question 19. Which of the following would likely trigger a claims cooperation clause in a reinsurance agreement? A. A dispute over the amount of premiums owed. B. A request for payment from the policyholder. C. The ceding company's failure to meet solvency requirements. D. The ceding company and reinsurer working together on claim investigation. Answer D. The ceding company and reinsurer working together on a claim investigation. Explanation: the Claims Cooperation Clause is intended to ensure that both the ceding company and the reinsurer collaborate when handling claims. This includes sharing information and coordinating efforts during the investigation and settlement of claims, which helps in efficient and accurate claims management. Question 20. Which type of reinsurance arrangement is commonly used by primary insurers to provide coverage for risks that exceed their retention limits? A. Surplus share reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Facultative reinsurance. Answer A. Surplus share reinsurance. Explanation: surplus share reinsurance is typically used when the primary insurer seeks coverage for risks that exceed its retention limit. In this arrangement, the reinsurer assumes a share of the risks above a specified retention amount, which helps the ceding company manage its exposure to larger risks. Question 21. What is the primary function of the excessive loss reinsurance agreement? A. To cover losses resulting from a single event. B. To cover cumulative losses that exceed the specified amount. C. To share losses between the ceding company and the reinsurer proportionally. D. To provide coverage for losses within the retention limit. Answer: B. To cover cumulative losses that exceed a specified amount. Explanation: excessive loss reinsurance provides coverage for cumulative losses that exceed a specified amount, often related to a single event or occurrence. This arrangement is typically used for large catastrophic events where the loss may be severe but is unlikely to occur frequently. Question 22. Which of the following is a characteristic of a quota share reinsurance? A. The ceding company retains a portion of the risk, and the reinsurer covers the remainder. B. The ceding company and reinsurer share premiums and losses in proportion to their agreed-upon percentage. C. The reinsurer covers losses only once the retention limit is exceeded. D. The reinsurance covers only specific, large risks. Answer: B. The ceding company and reinsurer share premiums and losses in proportion to their agreed-upon percentage. Explanation: in a quota share reinsurance agreement, both the ceding company and the reinsurer share the premiums and losses in a fixed proportion. This helps spread the risk evenly across both parties and is commonly used for a broad range of risks. Question 23. Which of the following describes the ceding commission? A. The fee paid by the reinsurer to the ceding company for administrative services. B. The percentage of premiums retained by the ceding company. C. The penalty for early termination of the reinsurance agreement. D. The amount of risk retained by the ceding company. Answer: A. The fee paid by the reinsurer to the ceding company for administrative services. Explanation: the ceding commission is the fee paid by the reinsurer to the ceding company to compensate for its administrative costs and efforts in underwriting, marketing, and servicing the reinsurance agreement. It is typically a percentage of the premium ceded to the reinsurer. Question 24. In reinsurance, what does the term per risk excessive loss refer to? A. Reinsurance that applies to losses exceeding a certain retention limit for each individual risk. B. Reinsurance that applies to aggregate losses exceeding a certain retention limit. C. Reinsurance that covers all types of risks under a single agreement. D. Reinsurance that applies only to large risks with high premiums. Answer: A. Reinsurance that applies to losses exceeding a certain retention limit for each individual risk. Explanation: per risk excessive loss reinsurance is designed to cover losses from individual risks that exceed a specific retention amount. It applies to large claims from single risks, such as a single building or automobile, and helps protect against unexpected, high-severity losses. Question 25. Which of the following types of reinsurance arrangements is best suited for managing the volatility of underwriting results? A. Facultative reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Stop loss reinsurance. Answer: D. Stop loss reinsurance. Explanation: stop loss reinsurance is ideal for managing the volatility of underwriting results by covering cumulative losses that exceed a specified amount. This helps the ceding company manage fluctuations in its loss experience and prevent significant financial instability. Question 26. What does the term retrocession refer to in reinsurance? A. The transfer of risk from one ceding company to another. B. The transfer of reinsurance risk from one reinsurer to another. C. A clause in reinsurance agreements that limits coverage to specific risks. D. The retention of a portion of risk by the ceding company. Answer: B. The transfer of reinsurance risk from one reinsurer to another. Explanation: retrocession occurs when a reinsurer transfers part of the reinsurance risk it has assumed to another reinsurer. This allows the original reinsurer to reduce its exposure and manage its risk more effectively. Question 27. Which of the following types of reinsurance helps a ceding company protect itself against the possibility of large, catastrophic losses? A. Quota share reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is designed to protect the ceding company from large catastrophic losses. It covers losses that exceed a certain threshold, making it ideal for managing high-severity, low-frequency events like natural disasters. Question 28. What is the purpose of A claims cooperation clause in a reinsurance agreement. A. To prevent the ceding company from submitting fraudulent claims. B. To require both parties to share claims-related information and collaborate in the claims process. C. To ensure that the reinsurer pays a fixed amount for each claim. D. To set a predetermined claim settlement amount. Answer B. To require both parties to share claims-related information and collaborate in the claims process. Explanation. A claims cooperation clause ensures that both the ceding company and the reinsurer work together when investigating and settling claims. This helps maintain transparency, improves the efficiency of the claims process, and ensures that the proper amount is paid out. Question 29. Which of the following is true about surplus share reinsurance? A. The reinsurer shares a portion of all risks up to a specified limit. B. The reinsurer automatically assumes a share of all risks, regardless of size. C. The ceding company retains a fixed percentage of all risks. D. The reinsurer only covers catastrophic losses beyond a certain threshold. Answer A. The reinsurer shares a portion of all risks up to specified limit. Explanation. Surplus share reinsurance involves the reinsurer taking on a portion of the risks from the ceding company, but only up to a predetermined limit. The ceding company retains the portion of risk that is within its retention limit, while the reinsurer covers the excess. Question 30. Which of the following types of reinsurance is most appropriate when the ceding company wants to transfer a specific large risk that does not fit into its regular portfolio? A. Quota share reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer B. Facultative reinsurance. Explanation. Facultative reinsurance is used when a ceding company needs to transfer a specific large risk that is not part of its regular portfolio. Unlike treaty reinsurance, facultative reinsurance is negotiated on a case-by-case basis for individual risks.